Good morning, everyone, and welcome. Thank you all for registering and joining this webinar, which is the 5th webinar in a series of webinars organized by the Launch Project. My name is Jasper Donker from TNO, the Applied Scientific Research Organization of the Netherlands, and I'll be moderating today's session. As many of you probably already know, the Launch Project is a project funded by the European Commission under the Horizon 2020 program. It's been running since May 2019 and will continue until late this year. The overarching objective is to accelerate and scale up growth in the sustainable energy market and to enable the aggregation of sustainable energy assets to create a market for tradable securities. So in order to achieve the objective of the Launch Project, the project team has been developing various standardized projects that can help to grow the market for sustainable energy assets. Tools include a standardized energy performance contract, which is an as-a-service agreement between a project developer and their end client, a standardized risk assessment protocol that provides a structured way and guide to collect information on risk types commonly seen in energy efficiency project investments, and materials to support equity raise and sales messaging. We have developed these projects, tools and templates in collaboration with our stakeholders, including the Launch Investor Board. We are therefore very grateful that today 3 members of the Launch Investor Board will present and discuss with you their perspective and experience on challenges, opportunities, and criteria when investing in sustainable energy projects or pipeline of projects. After their presentations today, the floor will be open to questions and answers. Before handing over to our first speaker, I'd like to run through some housekeeping with you. First, there is a box on the right side panel in which you can enter any questions you might have. Please feel free to write your question here during the presentation, and we will address as many as possible in the second half of this webinar. Second, in the same panel, you will find a section called Handouts. Here you can download the presentation that were made during this webinar. We will also be sending out a follow-up email with presentations attached and a link to the webinar's recording. Next slide, please. Our 3 speakers today are Peter Redford, Principal at Amber Infrastructure Limited, a specialist international infrastructure investment manager. He has over 15 years experience in finance and is involved in investment management and origination of funds in energy efficiency, energy generation, and urban regeneration, including 2 London-based ERDF funds, of which is one the Mayor of London's Energy Efficiency Fund. Our second speaker today is Philip Bouw. He is Director Impact-Based Finance at Société Générale. He's a customer-oriented commercial banker with over 25 years experience and expertise on, among others, embedding ESG and sustainable development goals aspects in financing, change management, and improving organizations' efficiency and innovation. Our third speaker today is Marco Pignoloni. He is a senior analyst at Arpinch, a private and institutional investment company, where he is responsible for project finance and financial modeling in the renewable energy and energy efficiency sector, as well as contributing to assess and manage investment projects for institutional counterparts. So I will now hand you over to Peter Redford from Amber Infrastructure for his investor perspective on investment in sustainable energy projects. Over to you, Peter.
Great. Thank you, Jasper, for the introduction. Morning, everyone, and thanks for the opportunity to briefly talk about what we look for when investing in energy performance contracting here at Amber. As Jasper said, I'm Pete Radford, and I'm a principal at Amber Infrastructure. Could I have the next slide, please? Great. So just briefly, a few words on Amber before I go into the main content of the presentation. So Amber is a fund manager with 6 funds under management. These funds range from our listed core infrastructure fund, IMPP, through to our digital infrastructure fund, which we look after on behalf of the UK government. All of our funds have an interest in the low carbon technologies that we're talking about today, but in particular our European Regional Development Fund backed leaf and spruce funds in particular have been investing in energy efficiency projects since around 2011, and to date we've invested somewhere over 200 million now into energy efficiency projects. If I could have the next slide, please. So what do we look for in an energy performance contract? I guess firstly, and the most obvious one, is we need to see a robust business case, and that should cover both the commercial and technical side of things. So will we get our money back, and will it work? They're key fundamentals to any project. We've also recently updated our own internal investment process to include a dedicated ESG analysis on each project, something that actually we've been working on as part of the Launch 22 process as well. The ESG point that I mentioned is, I think, very relevant for EPCs, both from the energy perspective, such as the promotion of, say, waste heat sources over say, a gas CHP-driven project, but also the social angle, as often the EPC that we're investing in will be impacting directly on people's homes and businesses, and in many cases addressing fuel poverty. The next two diagrams, standardization and scale, are in my view probably the biggest challenges that we face in the EPC market. I've seen several EPC style contracts over the last 10 years, ranging from, say, a couple of pages through to several hundred pages. I think the answer is probably somewhere in between the two. And I think it's key for, as a sector as a whole, that we try to minimise that variation in EPC contracts, so that they're, say, more aligned to how you would deal with a construction contract, where most of the variable parts of that specific contract are dealt with in schedules to the standard form contracts that are in place governing the relationship between contractors and investors and hosts on construction contracts. That said, I think it is fair to say that each EPC will be different, and different investors, and you'll hear more about this today, will have different commercial clauses within an EPC. But I think there's still a definite position where if you started with a base document and then worked outwards, I think that would promote a lot of standardization and therefore speed across the sector. And that's something that it's been great to be working with colleagues on the Launch 22 programme to deliver. I'm not going to go into the key terms of what we specifically look for in a standardized EPC contract on this call, as it will differ between each investor, and will probably take me a bit longer than 5 minutes. But if anyone wants to have a chat about what our specific position would be on some of the standard clauses within an EPC contract, such as termination rights, approach to savings, monitoring and KPIs, then obviously feel free to give me a call. The need for standardization, I think, is somewhat driven by the relatively small scale of EPCs to date. At Amber, across our 3 ERDF funds, we've tended to focus on, I think, what people would consider as relatively large-scale individual EPCs, and they range from, say, £1 million up to £25 million. And these often cover the energy upgrade to a whole hospital site, a whole university campus, or, say, a local authority estate. And in the UK, local authorities can own several hundred buildings, for example, within that area. And that's created that scale of 25 million for one specific project. However, this sort of scale of that size is more difficult in the private sector, especially the SME sector, and hence there is a need for standardization so we can aggregate all of these smaller projects together. I think it's also worth mentioning that the drive to net zero will mean that the amount of upfront capital for a EPC contract is likely to increase as we move forward, as we add more measures to each EPC to deliver those deep retrofit savings of 80%, 70-80% on the building, rather than, say, what historically may have been the case of 20-30% energy saving per building. Though the cost of some of those technologies that we're now implementing into an EPC are coming down, and that's great because it's creating greater value, the overall payback of the EPCs is likely to increase as we create more scale. But that in itself brings in the likes of ourselves of the longer term investors who have appetite for those longer paybacks. conscious I've only got about 5 minutes. I'll be a bit quick on these next three diagrams. With regards to governance, in the bottom left there, what I mean here is these are long-term contracts that we're entering into, and things are likely to change over the period of the EPC. So implementing a strong governance and process to deal with the governance that allows for change, be that say regulatory change, which we're seeing in the UK with heat at the moment, legal changes, or indeed technical changes as things advance. It's important to have that process in place at the start. This leads on kind of to the point of collaboration. Here I mean it's collaboration between the host, the building that's receiving the upgrade, the EPC contractor and the investor all working well together. And I think things like shared savings upside between all parties, but also more fundamental of regular contact, regular meetings between parties, and so that we can discuss issues which can be resolved before impacting on KPIs, for example. It is important to make that long-term relationship work, especially as you're often working with the same EPC provider and host on many future deals. I think finally, measurement and verification is worth a mention. I come from a banking background rather than a technical background, but over the last 10, 11 years, I've spent more and more time looking at the M&V side of each deal that we invest in. And I think M&V actually can be a tool in itself to bring in new investors into the sector. And we need to start being able to demonstrate that the current projects that we've delivered and the EPCs going on for many, many years now have been delivering the outcomes we expected, both on a carbon and hence financial perspective. So I think I do look forward to seeing sort of more standardization about M&V across EPCs. I think that would be very useful. On our funds, we use IPMVP for all of our deals, and that does then vary between which option of IPMVP we select. And we also have a set carbon factor at a fund level, so that every EPC that we invest in has that same position when it comes to it as analysing, is this a good EPC or a bad EPC, by setting that carbon factor to fund level, because obviously over time and over different types of technology, the carbon factor will change. So it sets that certainty day one. Can I get the next slide, please? So I wanted to finish off with just a couple of case studies which we've invested in. This one's a hospital site for a large trust in London. It's in total around about £25 million, long-term contract with Breathe, who are one of the leading EPC contractors in the UK. And the next one along, and on the next slide, we've got an aggregation of local authority buildings that we did with Breathe, the French ESCO. So in addition to what these two, which are really good EPCs, but what I would call as a pure EPC contract, we're also seeing in a number of other sectors such as energy savings agreements in the low carbon transport space, and we've recently invested in some charging for EV buses, but also in the retrofit of, say, gas CHP heat networks into water source heat pumps. I think it's these fundamentals that we're delivering in EPC contracting which will allow us to then expand into other sectors, which again increases scale and investor appetite in the sector. I'd be very happy to talk through people directly and share experiences, both the lessons learned over the last 10 years, but also the future opportunities that are in the sector. So without any further ado, if I could hand back over to Jasper and further presenters, that'd be great.
Yes, thank you very much, Peter. Very interesting insights in your presentation, like on where the investors look for in an EPC project. The aspects of standardization and scale that you mentioned, for example, relate very well with the launch project of the different tools. So thank you. As I mentioned earlier, I'd like to remind you all to please enter your questions in the box on the right side panel, and we will do our best to answer all of in the second half of this webinar. I'd like now to introduce our second guest speaker of today, Philippe Weil from Société Générale, who's, like Peter, also a member of our Launch Investor Board, to present the banker's perspective on financing sustainable energy projects. So Philippe, over to you.
Thank you, Jasper. I will speak about something slightly different today, which is impact-based finance. I will explain our approach and our commitment to innovation before jumping into the real topic of the day. My presentation will mainly discuss about energy renovation in housing. I have made this choice because I believe this is an example that we can use for our present work because it's a relatively mature market. And also, I will discuss today about how we could co-construct an innovative securitization scheme. Sorry. I received a few direct questions about securitization. This is the future of the EPC market, and so I will try to address that today. And then I will finish my presentation by showing a few references in the housing market. So first, SG's next slide, please. SG's is committed to positive transformation that was expressed back in November 2018 by our CEO, Frédéric Oudéa, in a new mission statement, building together with our client a better and sustainable future through responsible and innovative financial solutions. This commitment has then been recognized by several awards, like Robeco Sam's First Bank on the Environment in 2019, and number 6 in Europe across all ESG criteria. Next slide, please. So now moving on to impact-based finance. Actually, we place energy efficiency into a larger scope that is sustainable development. And we start from the fact that a sustainable world needs sustainable investments. According to the United Nations, $6 trillion must be invested every year until 2030 to reach the Sustainable Development Goals, and 40% of that is not finance. It is our view that this gap highlights the need for more private investment and private funding. Our team's goal is to help reduce the funding gap by co-creating with our clients innovative business solutions, thanks to our ecosystem and the use of digitalization. And we position ourselves internally as a catalyst to make impact projects bankable. Next slide, please. So our value proposition, and this is where we are now going to make the link with Launch 2020, is the following. Oftentimes, technical solutions exist to meet the Sustainable Development Goals, but there is a lack of investable projects. And we have identified 3 main hurdles that you see on the left-hand side of this page. Costs are too high, projects are too small, risks are seen as too high. Peter mentioned a few projects before that were relatively large in size. It is possible that the success of the high-scale renovation market is to be able to tackle smaller size contracts. I hope you share my view that energy performance contracts can face the 3 hurdles: the costs, the size, the risks. And this is why we decided to join Launch 2020. And here is what we believe we can do against these 3 hurdles. First one is to multiply impacts. Energy efficiency is a very important size of the aspect, but it is not the only one. We believe we can multiply impacts around energy efficiency contracts, energy efficiency projects. And we believe by doing so, we can collectively get a more frugal approach to multiply the impacts and also the incomes of the projects, whilst reducing the overall investment cost. Then simplify, standardize, aggregate. This is at the center of the Launch 2020 project, and this is absolutely critical, key to reach critical mass. And then, thanks to digitalization, collect, analyze payment and impact data, can facilitate a risk assessment, demonstrate the adequacy of impacts with risk and return, and facilitate portfolio diversification. Next, please. So once we are on our way to reach critical mass, new financing tools will be required. And securitization is one of them, and I will take that as an example. Banks and investors are key partners in making them come true, particularly when tackling a relatively new market. So first step is to for originators to provide assets that match investors' expectations in terms of risk and return. So this is where banks come in. They will, within their roles in such a transaction, they will first analyze the originators that will be put into the SPV. They will define the transactions that can be financed, particularly their coherence, the common theme between the deals, the assets that will be put into the transaction, the alignment between investor strategy and requirements. And then, of course, banks will also be there to provide some skin in the game, so some commitment to the transaction, and also to define the appropriate levels of first loss that originators will be required to keep. And then, of course, adequate tranching is very important, so that the right this tranching will enable the proper placement of the transaction. And of course, the good understanding and knowledge of third-party investors is always key. Next. So I will briefly present now 3 case studies drawn again from the residential mortgages, because that shows the potential size of the market, right? Once standardization has been reached, you can see there how big it can become in terms of transactions. So Ovian is a Dutch company, and it was able to issue 600 million last year, in 2019, sorry, of prime residential mortgages selected on energy price performance criteria. And then also in 2019, Société Générale issued a 1 billion positive impact covered bond. So this is not exactly a securitization, but close to it, using our SG's residential property mortgages. And we selected only the top 15 carbon efficient homes in metropolitan France within SG's mortgage portfolio. And that transaction obtained a second party certification on its alignment with UNEP-FI's principles for positive impact finance. And finally, iGreen, a US company, issued over $300 million securitization of PACE, Property Asset Clean Energy, in the US. This is not their first transaction. This is the 10th they've done on a PACE transaction. So always based on the residential and commercial energy efficiency market, with a specificity that is quite interesting, I think. The assets, so the loans are backed or are linked to the houses, not the borrowers. So the people who appeal to PACE, right, take a loan to make energy efficiency renovations, and that is related to the property. So when they sell the property, they also sell the obligations under this contract. So that is all for me today, and happy to take questions later.
Yes, thank you very much, Philip. Very interesting that you're pointing out the importance of scale as well, similar to our first speaker, but also show how to overcome this by aggregation and securitization, and the importance of standardization in that. Thank you very much. It's time now to move to our third and final speaker of today, Marco Pignoloni of Arpinch, for his investor perspective on investment in sustainable energy projects. Over to you, Marco.
Thank you, Jasper. I'm here today with my colleague Alvise Panizzi, who will help me to answer any possible question. And I'm here for Arpinge, which is an equity sponsor. Can you go to the next slide, please? Thank you. We are an equity sponsor investing in infrastructure, set up by three of the main Italian pension funds, supporting a long-term investment strategy into small, medium-sized infrastructures. We are not that big, so we have focused, until now, we have focused on the Italian market, and specifically out of many possible infrastructural sectors, which are renewables, energy efficiency, and car parks, even though we don't have any constraints in terms of countries or sectors. Just to give you an overview, we have around 350 million assets under management out of 1.1 billion pipeline in terms of enterprise value. Thank you. Next slide, please. Just to give you a snapshot of our company, we are not that many. So we have a small company in the world of the equity sponsoring infrastructures. We are around 15 plus some possible partners. So why am I telling you that? It's because we have to find a way to standardize the product, to standardize the investments, also to allow us to manage the investment process and the operation process, especially in energy efficiency, where opportunities are used to be small, or at least smaller than other sectors, like renewables or other infrastructure sectors. Next slide, please. So here, a snapshot of our screening process. So we had a lot of projects on the table for investment decisions, and only few of them reach the financial close or just the negotiation phase. The issue is that, like, some of them, they don't reach the final close because they are too big for our investment strategy, but some of them is also because they are not eligible for our investment criteria, or we don't match the expectation. We have different, let's say, criteria than the project has. So also they're like finding a way to make the project more eligible from the beginning, allow us to invest more, and allow project to be carried out, to be completed, at least with our investment criteria. And that will help us a lot in our investment process. Okay, thank you. Next, please. Thank you. In our portfolio, we have around 50% of renewables and 50% of car parks. Even though we have a very important energy efficiency project with the renovation of many supermarket stores, the share of energy efficiency in our portfolio is around 1%. That means that we have in the previous years, for many reasons, we have preferred to invest into other sectors. So that means that we have to find a way to invest more, which can be standardized more the process, the project, make the project more eligible for our investment criteria. To make that 1% larger in the coming years, we should balance more our investment portfolio. Here I would like to introduce you a couple of case studies. The first one is a good project. It's a very good project we have done. Let's say the best-in-class project in energy efficiency, while the second has some issues. Like in the first one, we supported the renovation of the energy efficiency renovation of 13 supermarket stores in a project finance structures together with an EPC with an ESCO as EPC and O&M contractor. The project was around 25 million big in terms of enterprise value, and until now the project has performed very well. The structure was like the typical structure where there was an SPV with a service contract with the single supermarket stores, and with like a fixed fee and a variable fee. What was very important for the success of this project was the support of our EPC contractor, of our ESCO, and the support of CONAD, the supermarket stores, to help us in the measure, the collecting of the variable fee, to allow us to speed up the process and to have a better management of the project. So I would say that this is maybe the best-in-class project, and maybe it's like our target project in investment. But we know that in energy efficiency projects are smaller, like there are different counterparts. So we have to find a way to standardize them to do similar projects also with smaller size. Next slide, please. Here I would like to introduce you like an investment platform we tried in the past years to invest into direct energy efficiency measures to industrial and commercial consumers. So we tried to invest directly into projects where like clients were chosen according to their credit rating profile. We were in partnership with some ESCOs, and we wanted to reach like a similar size of project, but in terms of aggregation. Until now, we have evaluated several projects, we have negotiated several projects, but until now, any of them has reached the final close. And I think that one of the issues was the time to market, the cost effectiveness. So the projects were usually too small, risks sometimes were too big for us, and on the other side, if risks were lower, also the final return was too low for our investment, and we prefer to invest in other sectors, for instance, where projects were bigger, return was more balanced according to the risk profile. So in the next slide, we tried also to analyze why this project didn't reach any financial close to any project, and we also had some discussion how to invest more and how to increase that 1% of energy efficiency share in our portfolio. And I think that a significant effort should be made behind the project to standardize the criteria of the project to help us to be faster and also to reach smaller projects, which is like the average size of energy efficiency. So in order to invest more for us, but also to support ESCOs to deploy more projects, I think that we will focus in the coming months to standardize more the project, also maybe to strengthen partnership with ESCOs, to delegate ESCOs to invest for ourselves. And the partnership can be a commercial partnership or a strengthened partnership, where like the ESCO will support us in the scouting process and in the operation process, leaving us like the financial part of the project. So in the coming slide, I would try to give you a snapshot of of the question our investment committee has, where when we try to introduce an energy efficiency project to invest in. Like these are the typical question in any sectors, but some of them are very specific to the energy efficiency market, where we have clients, so we have to be sure that the client will pay. We have to be sure that the performances of the project will be satisfactory. We have to be sure that in case the ESCOs will not support us anymore, I should be able to replace. As I was showing you before, we don't have a super big team, so we have to be sure that in case of issues, we should find a way to operate the project. And of course, like one of the main issues is how to make a bigger project also in terms of aggregation, how to scale the project to build up a portfolio of similar projects. So yeah, I try to give you our, let's say, our view of the energy efficiency market, which I think in some cases is common through energy sponsors, through equity sponsors, aiming for us to invest more and to find a way to invest more through standardization, standardization of the project and or on the evaluation criteria, especially from the beginning of the project, for us to have the project already packed in a way we can be faster and be smoother in our investment process. So thank you, and I'm open for any question you might have.
Yes, thank you, Marco, for your presentation and interesting insights. Very interesting, the funnel that you presented from screening to execution, as well as the main risks with dealing with energy efficiency projects. With the launch standardized risk assessment tool, we do exactly aim to contribute to this area, as you pointed out, and hopefully in the end increase the number of eligible sustainable energy projects also for your organization. So thank you for listening to the webinar presentations. We will now try to tackle the questions that you posed during the presentation. We have roughly 20 minutes, so unfortunately I don't think we will get through all the questions. If that's indeed the case, we will try to reach out to as many of you possible after the webinars and or bring you in contact with our speakers of today. So our first question is probably for Peter. What is your view on pooling of multiple energy efficiency projects as a way to reduce overall performance risks?
Yeah, I think that's, thank you for the question, and I think that is key. I think we would like to see both the pooling of numerous projects, if it's done in a standardized manner and similar risk profile from a sort of from a legal perspective, but while differing on like a technical perspective, actually gives the investor more comfort by having different different hosts and different technologies as a basket of a portfolio risk that kind of can improve the investor's appetite. It does mean that some of the, I guess, the least risky and best performing projects may not quite get the same cost of finance as some of the others, but it does create you know, a very good solution to the scale problem that we have, and from an investor appetite, it's something we're very keen to see, and it's good to see that the other colleagues on the call have already been exploring that solution too.
Okay, thank you. Peter, Marco, have you anything to add on that? Otherwise, I will move to the next question.
Thank you. I totally agree with Peter in his answer.
Okay, thank you. Marco, the next question is for you. You mentioned that some projects receive subsidies. Is there any experience with conto térmico or super bonus to ESCOs?
Well, in our view, I mean, subsidies. I mean, we have evaluated several projects with conto térmico, the Italian conto térmico, and we are now evaluating some possible operation into eco bonus, which is like a very strong bonus on renovation of building renovation. We are a bit scared in terms of subsidies. I mean, we evaluate subsidies very carefully because we have we don't have a very good track record on that. So for us, it's very important that a project that the drivers of a project are energy savings first, and like subsidies will be a share in the revenues. But of course, we are open to invest into projects with large subsidies, but we are, I mean, we consider them with quite worries. We had experience with the renewables when there were some change in law, and so we have to act very carefully on that. But we, of course, are open to any evaluation in terms of any possible subsidy schemes as conto térmico or eco bonus. I don't know if Alvise, you want to add anything to my answer?
No, Marco, I think you have been really clear on the explanation. The thing that we are scared about sometimes is, as you said, changing law. So the project that we are evaluating must be solid itself, and then the subsidy scheme is something that comes later, and it is a sort of surplus. But I agree with what you told before.
Yeah, like we evaluate like a base case without subsidies, and if there are subsidies, of course we are happy. Of course, the base case without subsidies should have a lower return than our expectation, but we are also happy if there are subsidies, but we are quite careful on that.
Okay, thank you. Moving on to the next questions. A question for Philippe. You talked about the securitization. What is the minimum ticket size of securitization, and what are the main attention points?
Securitization typically is at least 100 million euros because there are legal costs related to it. So you cannot do too small a securitization, and 100 million euros is probably a very strict minimum, right? It's as you saw in the examples that I showed, it can be much more than that. Now, main attention points. So I think that the first one is that asset originators must have a strong knowledge of the underlying market and the assets, and the obligors as well. So they must know exactly what they are offering, and that will be scrutinized when being introduced into the vehicle. Second, banks must ensure that a proper due diligence is made, and that it has a good knowledge of the originators, because this will be a relatively long-term relationship, right? So banks will ensure that they are partnering with people that they know. And also, banks must ensure a good distribution capacity, of course, of the assets. And finally, good knowledge, that relates to maybe to the previous point, a good knowledge of the investor base to match the profile of the transaction with the investor strategy. That are the three main points I want to highlight.
Yes, thank you very much, Philip. Moving on to the next question for Peter, and maybe later on also for Marco, but let's start with Peter. What is your view on energy price risk? Should it be allowed in the ESA contracts?
That's a good question. Sometimes you'll see, sometimes you'll see the energy savings based on kilowatt hours, and sometimes that'll be a pound saving. Because we're a relatively low risk investor, our EPCs are based on kilowatt hour savings rather than price risk. So you're guaranteeing a kilowatt hour saving to the host, not necessarily a price risk. That said, I think it depends on how much risk you want within your energy performance contract, and I'm sure there are some energy performance contracts that will take price risk as well on the energy.
All right, thank you. Marco and Elvis, do you have something, or what is your perspective on this?
Yeah, it's a good question also for our perspective, because I think that there are two sides of energy risk behind the project. One is like how, how much energy savings, how much economical savings will depend on the energy prices, and this is quite tricky. And we will evaluate that according to sensitivities. And the other risk is how much the project is linked to energy supply. So if I have to supply to a consumer energy like natural gas or like other electricity, and this is quite tricky because it increases the client risk, and also it has to be carefully evaluated, the alignment, the match between operating costs and revenues. So it has to be carefully evaluated as well.
Yes, thank you. And the next question is for you as well, Marco. On your last slide, you mentioned something of conflict of interest and legal structure. Can you give some examples of that?
Yeah, I mean, I think that in energy efficiency investment, it's very important the presence of ESCOs, to support us in the management and the operation and construction of the project. So I think that it's very important to understand, to match the balance between our goals, so have an IRR, and the ESCO's goals, so to have industrial margin, industrial profits. So we have to find a way where there is a balance. So I don't have to consider in my business plan operating costs which are too low than the average market, because just the ESCOs promises me to do that price, but I have to carefully evaluate this balance. Also because we will be partner with the ESCO for the entire duration of the project, so we have to build up a sound structure, which should be a winning structure for us, for the ESCO, and for the client itself. I don't know if Alvise, if you want to add anything.
No, thank you. I have nothing to add to your answer.
Okay, thank you. Moving on to the next, Peter, how to mitigate construction risk on ESCOs and EPC contractors performing the construction?
Cool, that's a good question. I mean, if you look at how a normal construction contract works, there will be things such as performance bonds retention bonds and potentially parent company guarantees on the ESCOs, which obviously gives you some comfort of an investor through construction. And also things like milestone payments against the construction contract are minimise the risk that you have at the time. Point in time. I think this is a good question, especially given some of the ESCOs into the sector are SMEs and looking to grow. So I would say that in some of our EPCs we have supported SMEs to do what I think are relatively large contracts for their initial for an SME. So there is a probably slightly greater risk maybe during the construction phase on EPCs, given that the ESCO market it does have a number of SMEs within it, and things like performance bonding and retention bonds can help get the investor comfortable on that side of things. So there's mechanisms within the construction contract to help bring SME ESCOs to the party, which I think is important.
Thank you. Philip, what are the challenges of integrating non-energy impacts of energy efficiency into business models?
Well, the major impact is that they are difficult to value. So oftentimes, or to monetize. So oftentimes, for instance, if I take an example about renovating an industrial process, it is most likely that that can have impact on the employees' well-being, for instance. If there are less variations of temperature in the warehouse or in the factory, if illumination is better, well, probably those guys will have less illnesses or diseases, and one can expect that will improve over time the profitability of the plant. But this is usually not taken into account by CFOs when evaluating the various investment opportunities they have. So this can be one difficulty we can face.
Yes, thank you. Marco, you said that you had not a good track record with subsidies. Do you see the main risk in potential changes in the law or some other aspects too?
Well, I mean, usually when subsidies are high, like an equity sponsor always is worried about the level of subsidies. Of course, we are open to evaluate subsidies. In our portfolio, we have a lot of renewables with subsidies. Like our consideration was also to balance our portfolio risk. Like in renewables, we have like subsidy risk and of course performance risk. We saw energy efficiency more to have a different to balance the risk, so to have a client risk, market risk, rather than having too much exposure to subsidies. But of course, we are open to evaluate. I mean, we are also happy that subsidies will help energy transition and energy efficiency. In some cases, subsidies are necessary to boost energy efficiencies, like in residential buildings or in some cases.
Yes, thank you. The next question is for you, Peter. Who was the borrower in your two projects that you presented, the ESCO or the public entity?
Yeah, so in those two specific ones, the borrower is a public entity. It can vary. Sometimes it's the borrower, sometimes it is the public entity, sometimes it is the ESCO and / an SPV as part of the ESCO. So in those two cases, because of value for money reasons on the public sector, it is the the public entity that borrowed. We have got some of the projects that tend to be more in the private sector that have been delivered through where we've lent to the ESCO or created an SPV. So it can vary, two different models. Both have their own positives and negatives. So it's important that a host considers both of those options, I think, before entering into an EPC.
Yes. Okay. Thank you. Moving on to, I think, one of our final projects questions. Sorry. And that's for you as well. Do investors favor one type of technology? Sorry, Peter, question.
Yeah. So, do we favour one type of technology? No, we are totally technology agnostic, other than we would think about the technology in relation to ESG. So, at the moment, things such as heat pumps and heat networks that are forming part of the EPC that come from waste heat would be favoured over more traditional heat networks using gas boilers, etc. So we will look at the technology risk as across the deal. That may have an impact on pricing, but we are relatively technology agnostic. The other point, I guess, to mention, and that's already been raised, is some technologies do come with a subsidy, some technologies don't come with a subsidy, and that could be taken into account into the business case.
Okay, and another follow-up question: are investors geographical specific?
Yeah, I mean, our ERDF funds are because that's the financing is being brought to those specific regions. But I think one of the key things is that when we're talking about standardization, the great thing about projects like, to a certain extent, Launch 2020, is that you're creating standardization that can work across many different jurisdictions, and the concept of EPCs is relatively similar across the whole of the European Union and beyond. So we would, definitely like to see cross-border or non-UK EPCs coming through our pipeline.
Yes, thank you, Peter. Unfortunately, we are reaching the end of this webinar. So indeed, we did not get the chance to go through all the questions, but we will reach out bilaterally to as many of you as possible with responses or bring you in contact with our speakers of today. If anyone has any further questions, please feel free to contact us either via the website or the contact details that you can find below, but also in the slide pack of the webinar. You will also receive a link to the recording of the webinar, and we encourage you to share this with your colleagues and others in your network who might be interested. Finally, please do sign up via the Launch Project website to participate in our next events and find more information on these events and other ways to participate in this project. Thank you very much once again for attending the webinar. A big thanks to you, Peter, Philippe, Marco, and Alvis for your excellent presentations and answers to the question. We look forward to being in touch with you over the course of the project. Thank you.